So in this video we will be discussing the three types of risk. Number one is interest rate risk, number two is reinvestment risk, and number three is default risk. So let's begin. Risk number one is interest rate risk. The risk of a decline in a bond's price due to an increase in interest rates. So this is related to the inverse relationship you have already studied. The market interest rate and the bond price have an inverse relationship. So if the interest rate will increase, the bond price will decline. Bonds are an investment for your investor, and if that investment's value comes down, that will be detrimental to the wealth of the investor. For example, let's think of a bond. So there is a bond which has a par value of 1000 and it is also selling for 1000. At that time the market interest rate was 10% and the coupon rate was also 10%. That's why it's trading at par. Now after 1 year the market interest rate has gone up to 15%, due to which the bond price has declined from 1000 to, let's say, 800. So the investor who had purchased the bond for 1000, now his investment has a value of only 800. His wealth has decreased because the investment's value has decreased with time. Plus, instead of getting the higher 15% rate, the investor is stuck with the 10% interest rate. So this is the interest rate risk. For bonds with similar coupons, differential interest rate sensitivity always holds true. The longer its maturity, the more its price changes in response to a given change in interest rate. This is saying that the longer the maturity of the bond, the higher will be interest rate risk in that case. So let's look at another example to understand this. So let's think of three bonds. One has a maturity of 15 year, another has a maturity of 10 year, and one more bond which has a maturity of 2 year. The price of all three bonds is currently 1000 because the market rate and the coupon rate are currently equal at 10%. So the market interest rate is also 10% and the coupon rate is also 10%. Now let's say that the market interest rate goes up to 15% after 1 year. Whenever the market interest rate goes up, the bond price will always decline. So it will decline in all three cases. The difference will come in the magnitude of the decline. The 2-year one will not decline that much, 950 maybe. The 10-year bond will have a higher decline, and the 15-year bond will have even more higher decline. So if you compare all three of them, the price has declined in all three cases, but there is differential interest rate sensitivity. The bond with the longer duration will have the higher decline, whereas the bond with the lower duration will have the lower decline. जो बॉन्ड ज़्यादा ड्यूरेशन का होगा वहाँ पे बॉन्ड प्राइस ज़्यादा तेज़ी से नीचे की तरफ आएगी कंपेयर टू अ बॉन्ड जिसकी ड्यूरेशन कम है. दिस विल ऑलवेज होल्ड ट्रू. Why is this the case? This is because this is because the longer the duration of the bond, the longer your money is stuck at one place. So if you have invested in a 15-year bond and the market interest rate increases for 10% for 15%, you will have to wait for the next 14 years to get your money back. After you get your money back, then you can invest in the higher 15% rate. Whereas if you look at the 2-year bond के 2 साल बाद आपको पैसे मिल ही जाने. So even if the interest rate has gone up to 15%, 2 years later you will get back your money, and you can invest your money back at the higher interest rate of 15%. So because your money is stuck for a longer time period in the 15-year bond, interest rate risk is higher over here, whereas in the shorter duration bond, interest rate risk will be less. Now, moving on to the second type of risk, reinvestment risk. The risk that a decline in interest rate will lead to a decline in income from a bond portfolio. So, the second type of risk takes a opposite stand. In the first risk, interest rate risk, we are interested with the market interest rate increase, and we said that the bond price will decline. This is interest rate risk. Now we are interested in what will happen if the market interest rate decreases. Is there any risk in this case? The answer is yes, and that risk is called reinvestment risk. Let's look at an example. I'm going to remove what I've written before. So let's assume you have invested in a bond which has 10% coupon rate, and even the market interest rate is 10%. So the bond is trading at par of 1000. Now let's assume that the market interest rate has declined to 5%. Now, if your bond has a shorter duration of, let's say, 2 years, 2 years later, when your bond ends, you will have to reinvest this 1000 at the 5% lower interest rate. So reinvestment risk is related to, it's in the name, कि जो आपकी इन्वेस्टमेंट है अगर आप उसको दोबारा से इन्वेस्ट करो तो आपको लोअर इंटरेस्ट रेट मिले. This is called your reinvestment risk, and it will obviously be higher on callable bonds and short term bonds. शॉर्ट टर्म बॉन्ड्स में आपको जल्दी पैसे वापस मिलेंगे, तो आपको दोबारा से सोचना होगा कि पैसे को कहाँ पे इन्वेस्ट करें, एंड हो सकता है आपको लोअर रेट मिले. यू वॉन्ट गेट अ हायर रेट वंस अगेन. कॉलेबल बॉन्ड्स में ये रिस्क ज़्यादा इसलिए होता है. कॉलेबल बॉन्ड्स आर बॉन्ड्स दैट कैन बी कॉल्ड बैक बिफोर द कॉरपोरेशन बिफोर इट्स मेच्योरिटी. सो कॉरपोरेशन चाहे तो कॉलेबल बॉन्ड्स में बॉन्ड को वक्त से पहले ख़त्म कर सकता है, कॉल बैक कर सकता है. सो इन दैट केस, when will the corporation call back its bond? When the market interest rate will decrease. Reason being, let's again assume कि corporation ने bond issue किया हुआ है at the 10% rate. 1 year later, the market interest rate goes down to 5%. So the corporation has the option now that if they want, they can end this 10% rate, इस bond को ख़त्म कर दें, call back कर लें, give the investors their money back and issue a new bond at the 5% rate. For the corporation, their interest expense has declined from 10% to 5%. So if they have a chance of doing that, they will do it. Callable bonds are therefore called back usually when the market interest rate goes down. And that means for the investors a loss of income, because the investor was enjoying a 10% rate, a 10% income. Now they will have to bear the 5% rate. तो उनकी तो इनकम कम हो गई. So interest rate risk is related to the wealth related to a bond. The bond value decreases over here, whereas reinvestment risk is related to the income from a bond portfolio. Over here, the risk is that the income will decrease from your bond portfolio. Moving ahead, the last type of risk is default risk. It is the chance that companies or individuals will be unable to make the required payments or their debt obligations. Default risk is simply that the other party, the corporation in this case, is unable to make payments. So default risk is the risk related to that the other party is unable to make due of their obligations. So in this case, the corporation is unable to make the payments that they had promised, which means they might default on the interest payments and they might not return you the par value. Bonds have been assigned quality ratings that reflect their probability of going into default. The three major rating agencies are Moody's Investor Service, Standard and Poor's Corporation, and Fitch Investor Service. So these three organizations provide rating services. They provide rating for different bonds. The higher the probability of default, the higher the premium and thus the YTM. So if you compare two bonds, one is a government bond and the other is a corporation bond, which one will have the higher interest rate? The answer is the corporate bond will have the higher interest rate. Reason being, the corporate bond has a higher chance of default compared to the government bond. Because the government bond is a safer security, the interest rate over here will be low. The rule in finance is that the higher the risk, the higher will be the return. So government bonds are safe securities, that's why their interest rate will be less. Their YTM will be less because the investors do not need a very high rate for compensation. They are happy with a lower interest rate knowing that the security is safe. Whereas for a corporate bond, they might require a higher interest rate because over here the risk of default may be higher. Now it depends upon which company you're also making an investment. If you're making an investment in a new corporation which doesn't have very stable income, so that corporation will have a higher YTM compared to another corporation that has stable earnings and which is a mature company. Depending upon who issues the bond, your default risk will vary. Government securities are considered to be the least risky because they are backed by the government and by the state bank. Then you have municipal, which are local government bonds, and then you have corporate, which are of the corporate sector. Lastly, you can even have foreign bonds, so you can purchase a bond of a US company, of an African company, but over here you will have to bear another additional risk, which is your exchange rate risk. So if you're making a foreign investment, you will have to bear with the exchange rate risk as well. These are how the ratings are provided by the organizations. So you can see Moody and S&P, they provide a rating based like this. AAA to B, AA and BBB are investment grade bonds. So these are safe securities according to Moody's and S&P. Whereas junk bonds are securities with a rating of BA to C and BB to C. These securities are high risk securities. So the risk of default is high in junk bonds, but because the risk of default is high, these bonds will offer a higher interest rate compared to your investment grade bonds. However, many corporations are not allowed to make investment in junk bonds. So it depends what is your priority. Will you go for the safer security but the lower rate, or the higher default risk security but with the higher interest rate? These ratings can vary with time. So a corporation can shift from AA to A to B depending upon the situation. The ratings for a bond can change. The ratings are based on numerous measures which include qualitative factors as well as quantitative factors. So ratio analysis of the corporation is done. You have already done financial statement analysis. You know that the ratios tell a picture about the company's financial position. Over here, your debt management ratios are the most important ratios, and apart from this, qualitative factors are also considered. Who is the key customer of the business, which markets does the business operate in, and so on.